Hello, everyone, and welcome back to the deep dive. I hope you are strapped in and ready for an intense analytical session, because today we're going to be dissecting a company that just seems to defy gravity, logic, and, well, traditional valuation models.
It really does. We are undertaking a comprehensive deep dive into Ferrari, a name that evokes speed, prestige, and, a huge financial anomaly in equal measure.
The what today is fundamentally a paradox. On the balance sheet, you see an automaker, right? A heavy manufacturer. But if you look at its stock price, its margins, its business behavior, it trades like a software house, or maybe, as we'll argue, the ultimate luxury goods house.
Which brings us straight to the why. The central question we're tackling is, well, it's almost existential. Given its stratospheric market valuation, does this meticulously constructed fortress of exclusivity truly protect Ferrari from market corrections? And more critically, from the technological disruption of electrification.
Exactly. We need to find out where the true value lies and if the market is correctly pricing in the massive technical risks that are just around the corner.
That's a fascinating dichotomy. Unparalleled safety right now, but maybe existential risk in the future.
Okay, so let's unpack the mechanics of this business. But before we fully immerse ourselves in the scent of Italian leather and the roar of a V12 engine, we do have a quick note for everyone watching.
Yeah, and that note is important. Before we dive into the specific financial models that support this whole luxury valuation, we want to make sure you have the tools to act on the insights we discuss.
Exactly. For those who want to execute these investment strategies, having a professional-grade platform is essential. We, of course, use Interactive Brokers, and we've partnered with them to offer our viewers a pretty substantial stock bonus when you sign up using our dedicated link.
So you gain access to a powerful platform, get a bonus to grow your portfolio, and you're also supporting the deep analytical work that goes into this show. That link is right there in the description below.
That's right. And of course, if you find value in this kind of rigorous, in-depth discussion, the best way to let us know, and to make sure you don't miss the next one, is to subscribe and hit that like button. It truly helps the show grow.
Perfect.
And if you have any questions or counter-arguments, please jump into the comments section and let us know.
With that out of the way, let's get into the core analysis. Pillar number 1. Understanding the true nature of this business, what we're calling the fortress of exclusivity.
And this reframing is absolutely non-negotiable. We are not analyzing vehicle production here. We're analyzing the manufacturing of the ultimate status symbol. You have to think of this as an industrial-scale art house, not an assembly line.
That is the perfect analogy. The core revenue is simple, selling ultra-luxury sports cars. But the strategic genius, the foundation of the whole moat, is what they control. And the crucial detail is the artificial self-imposed limit on production.
Right.
They ship approximately 13,600 units per year. This low-volume cap is the foundational layer of the entire financial fortress.
I think we really need to linger on that production cap because it fundamentally breaks every rule of traditional manufacturing. I mean, any CEO of a mass market brand facing soaring demand would spend billions doubling capacity, right? They'd chase volume. Ferrari actively refuses to do that.
They refuse.
So why is 13,600 the magic number? What happens if they just cross it?
Well, that number, or really the principle behind it, is everything. It's a corporate manifestation of the scarcity principle. Enzo Ferrari's famous maxim to always produce one car less than the market demands. That's not just marketing talk, it's a financial control mechanism.
Okay.
If they crossed 20,000 units, the waiting list would shrink, the resale market would soften, and critically, the price of an entry-level Ferrari would feel less like an exclusive club fee and more just a high price. They're managing scarcity to inflate desire and protect asset value.
But if they cap the volume, they still have to deliver that 10-15% earnings growth the market expects, the growth that justifies that 50x multiple. So that means the core sale of the car has to be subsidized by something else. That brings us to the true profit engine.
Exactly. They are forced to decouple volume from growth by maximizing the revenue from each unit sold. The massive profit engine is derived from personalization and customization. We are talking about custom leathers, bespoke paint mixes that take months to formulate unique carbon fiber weaves.
And what are the economics of that customization? I mean, how profitable is that?
They are phenomenal. When a client buys a base car for, say, 250,000 euros and then adds 80,000 to 150,000 euros in personalization, those options are almost pure profit.
Wow.
The R&D for the personalization studio is already sunk. The cost of labor for a custom paint job is minimal compared to the price charged. Those margins often run at 80 to 90%, so they're manufacturing a 250,000 euro vehicle and then selling 100,000 euros of incredibly high-margin services on top of it.
So the volume cap doesn't kill growth, it just forces them to be smarter about how they extract revenue.
Precisely.
And just to briefly complete the picture, what about the other revenue streams? Are they meaningful?
They provide some color, but they're minor pillars.
Yeah.
Engine sales to Maserati are phasing out as Maserati goes electric, which is, a headwind, but it's manageable. That revenue had lower margins anyway.
Okay.
The stronger parts are the brand licensing, Formula One, lifestyle goods, watches, which protects the brand and provides steady cash flow. But the core valuation rests squarely on the cars and that personalization revenue.
Okay, now let's move into why this demand is so structurally resilient. This idea of the Lindy effect, but applied not to technology, but to, human desire for status.
This is why the model is so simple and so robust. The core thesis is that they sell the ultimate status symbol to the ultra-wealthy. This desire is millennia old. Whether it was classical art or Renaissance jewelry, the human desire for status and beauty has been proven over time. It's a Lindy effect proven behavior. It's not going anywhere.
And when you anchor that enduring human desire with modern structural dynamics, the math for demand becomes inescapable.
It is a mathematical certainty, not some cyclical wish. The global number of high-net-worth individuals, people who can comfortably afford a Ferrari, is structurally rising year after year in the U.S., Europe, and especially Asia.
Right.
All of these new and existing wealthy individuals are running directly into Ferrari's capped supply of 13,600 cars per year.
It's the ultimate supply-demand imbalance built on, human vanity, which leads us directly into the economic definition of the moat. Veblen good dynamics.
This is the critical analytical pivot. Ferrari's primary moat is its intangible asset, the brand, the racing legacy, and the Veblen good status. If you analyze this as a car stock, you just fundamentally misunderstand it. It has to be analyzed as a luxury goods house, in the same category as an Hermes Birkin bag or a Patek Philippe watch.
Can you explain the Veblen demand curve for our listeners? Because it's completely counterintuitive to basic economics.
Sure. In a typical market, if you're selling a commodity, say a Honda Civic, if the price goes up, demand goes down. That's the normal demand curve. The Veblen demand curve is the opposite. Demand increases as the price increases.
Because the high price is the feature.
Precisely. The price itself signals status. If a Ferrari costs the same as a Porsche, it would lose its social utility to the ultra-wealthy. The fact that it's astronomically expensive and that only a select few can get an allocation, that's the very product they're buying. The price point acts as a membership sieve.
And we saw this playbook executed perfectly with the Purosangue SUV launch. This was them entering the most volume-hungry segment of the market, but doing it completely on their own terms.
The Purosangue launch was a masterclass in reinforcing their moat. They priced the vehicle nearly double its main rivals, like the Lamborghini Urus. And despite the staggering price, Ferrari was completely overwhelmed. They stopped taking orders within months.
Wow.
And they announced they would limit Purosangue production to only 20% of their total annual volume to keep it exclusive.
That decision to cap your highest demand product at 20%, that is the ultimate proof of the scarcity principle. They are sacrificing millions in immediate revenue to protect billions in long-term brand equity.
Absolutely. And that ties directly into their sales strategy. It's about reinforcing the ecosystem. You don't just buy a Ferrari. You enter a whole hierarchical system.
You have to buy your way into the inner circle.
Correct. Ferrari uses its strict allocation system to prioritize existing clients. You can't just walk into a dealership and buy an Icona Series hypercar. You have to first buy the normal production cars, the 296 GTB, the Roma build-to-purchase history, and only then will you be invited to buy the truly special cars.
It locks in customer loyalty for life and makes the moat impenetrable.
Exactly, and the moat is actively widening. They're increasing the average selling price without touching that volume cap.
Right, through things like the Icona Series.
The Icona Series is brilliant. These are limited runs of hyper-exclusive cars priced at 2 million euros or more. They're effectively selling art objects that happen to be drivable. So by pushing customization and introducing these ultra-high margin additions, they fundamentally decouple revenue growth from unit volume.
So if we look at this through the lens of mental models, we have the scarcity principle driving urgency.
That's the first lever. And then you layer on the social proof mechanism.
The self-reinforcing loop.
Yes. The more difficult the brand is to acquire, the more the elite must have it to signal their belonging. Owning a Ferrari isn't about getting from A to B, it's about signaling your position in the global wealth hierarchy. They are buying the recognition that they are one of the chosen 13,600.
It's just a masterclass in applied psychology. Okay, let's transition into pillar 2, operational proof and resilience. Why does this business stand so far above its competitors, not just financially, but emotionally?
Well, first, let's look at the competitive landscape. The rivals are pretty clear. Lamborghini, which is part of the huge VW group, McLaren, a brilliant engineering firm, but financially volatile, and Aston Martin, which always seems to be struggling with solvency.
But doesn't Lamborghini's high-volume SUV strategy with the Urus generate faster cash flow? Isn't Ferrari leaving money on the table by being so constrained?
That's the critical challenge, right?
Yeah.
Yes, Lamborghini's more aggressive. The Uru's over half their sales. They get higher unit growth. But Ferrari counters with a higher quality of earnings. Lamborghini is chasing volume, which in the long run suits their scarcity. Aston Martin and McLaren, well, their cars just don't retain resale value. They are manufacturing depreciating assets.
Which brings us to Ferrari's undisputed killer advantage, residual value. This is the key difference between buying a luxury car and buying a luxury asset.
This is the most rational argument the wealthy have for buying an irrational product. While nearly all luxury sports cars are liabilities that depreciate rapidly, a well-maintained Ferrari is often an appreciating asset. I mean, look at models like the 458 Special or the F12 TDF. They can easily sell for 20 to 50% more than their original price years later. This dramatically lowers the total cost of ownership, making the high price a rational rotation of capital into a liquid, collectible asset.
The wealthy aren't spending money, they're investing it into something they can also drive. That's a huge advantage over every competitor.
Okay, let's talk about the culture of the brand, customer and employee sentiment.
The customer love is, well, it's fanatic. The Tifosi, the global fan base, and the owners exhibit almost cult-like behavior. This gives the company a unique immunity to minor flaws. Owners tolerate infotainment glitches that would be completely unacceptable in a high-end Porsche. They tolerate it because they value the soul and the driving emotion above all else.
And as you mentioned earlier, the typical customer complaint isn't about the car. It's about access. Correct. The most frequent complaint you hear is, I can't get an allocation. They have the money, but the company tells them, wait, or buy 3 of our other models first. That dynamic is the strongest sign of a powerful scarcity model working exactly as intended.
And what about the people building these things, the employees at Maranello?
It's extremely demanding, but employee sentiment is exceptionally high, like 4.0 or above on Glassdoor. Working at Maranello is a matter of national honor in Italy. The culture demands perfection, but the mission is clear. You are contributing to a masterpiece. That inherent passion is a form of non-monetary compensation.
Let's pivot to management stewardship. The leadership has to balance this delicate old heritage with the massive technological challenge of electrification.
The appointment of CEO Benedetto Vigna in 2021 was a strategic masterstroke. Vigna comes from a hardcore semiconductor and tech background. His appointment signaled that the board understands the primary challenge is no longer speed or design. It's the integration of complex, proprietary technology while preserving that emotional heritage.
And his philosophy seems to be proprietary distinctiveness. He's not going to sacrifice the brand for convenience.
Absolutely. Vigna understands the premium evaporates if you can get the same experience elsewhere. They refuse to buy off-the-shelf software or generic screens. If a component doesn't add to the distinctiveness or the emotional impact of a Ferrari, they will engineer it themselves. They know that if the driving experience feels like a mass-market rival, the 50x valuation is gone.
That long-term focus is protected by the ownership structure, right? This isn't a company beholden to quarterly earnings.
That's a key insulator for the whole investment thesis. The company is effectively controlled by Exor, the holding company of the Agnelli family, which has about 36% of the voting power. This ensures a multi-generational time horizon. Management can make decisions that protect the brand 20 years from now, even if it means sacrificing immediate sales.
And that restraint is reflected in their capital allocation strategy.
Highly rational and restrained. They're reinvesting heavily in R&D for the hybrid and EV transition. They're spending on brand preservation like building the new E-building in Maranello, which is dedicated specifically to their proprietary electric powertrains.
And they return capital, but the real key is resisting that urge for volume.
Yes, they deliver returns via consistent dividends and share buybacks. But the most important act of restraint is resisting the temptation to double production to 20,000 units. That would spike short-term profits, but it would just as quickly erode long-term brand equity. Their constraint is their greatest strength.
Okay, let's move to pillar 3, the financial physics of luxury. This is the bedrock of the bull case, why the stock trades like a tech company. The numbers really do justify the valuation.
This is where we go from brand psychology to undeniable financial metrics. We have to look at profitability, and Ferrari is just in a league of its own.
What are we talking about in terms of margins, and how do they compare?
We are talking about EBITDA margins consistently hovering around 38%, sometimes even climbing toward 40%. To give you some perspective, that is double the margins of Porsche, which operates around 19%.
Double.
And this 38% margin rivals the most successful luxury fashion houses like LVMH. This isn't car company profitability, it's luxury goods or software profitability from an industrial company.
So why is that gap between Ferrari and Porsche so vast? What's driving that efficiency?
Well, a few things. First, the incredible pricing power from the Veblen dynamic. They can hike prices 5–10% a year with zero demand elasticity. Second, the pure profit from personalization, which we talked about. Third, their advertising spend is relatively low. The Scarcity and the F1 team do the marketing for them.
So the market, in valuing the company at a PE of 40x to 50x compared to Ford at, 4x? It's not being irrational.
It's a correct classification. The market has correctly identified this as a luxury growth stock with high predictability, thanks to that massive order book, and immense resilience during downturns, because their customers aren't affected by recessions. This premium is permanent if the luxury status holds.
Let's look at the quality ratios, starting with return on invested capital, or ROIC.
Their ROIC is excellent, consistently over 20%, sometimes hitting 25%. This shows high capital efficiency, which is extremely rare for a manufacturer. A typical manufacturer struggles to hit 10%. Ferrari operates without tying up billions in stagnant inventory.
And their free cash flow conversion is exceptional. They have a unique advantage with their client base, right?
Absolutely. The business runs with negative working capital in many cycles. Think about it. Clients are paying substantial non-refundable deposits just to get on a waiting list. This client money acts as a source of float for the company, funding operations before the car is even built. It's a powerful, zero-cost financing mechanism.
And the balance sheet reflects this discipline.
The industrial core is often near net cash or zero net industrial debt. This is vital. Any debt you see is typically held in their financial services arm, and it's backed by the appreciating Ferrari itself. This fortress is built on financial prudence, not just brand.
So what does a margin of safety look like when a company is priced for perfection? We can't look for statistical cheapness here.
No, the traditional margin of safety, a PE under 20, is highly unlikely to ever happen unless the whole thesis breaks. The cheapness is structural safety, not a low multiple.
So the true buffer is entirely in that 2-year sold-out order book.
That's the ultimate financial moat.
Yeah.
If the global economy entered a severe recession tomorrow, Ferrari has 2 years of revenue already contractually signed, guaranteed by deposits. This provides unparalleled revenue visibility and protects cash flow in a way no competitor can match.
Okay, here's the critical juncture for an investor. The price is the final hurdle. If you're buying at 45x or 50x earnings, you are betting entirely on future execution and growth, not on the multiple expanding further.
Correct. You are paying for perfection. At this valuation, your expected return is entirely dependent on them delivering a continuous 10 to 15% compounded annual growth rate in earnings. And that growth cannot come from volume. It has to come from pricing and mix shift.
Which transitions us perfectly into Pillar 4, the existential risks and catalysts. We need to dissect how they achieve that growth and what massive risks could permanently impair that luxury status.
The growth engine, as we said, relies on 2 levers. Pricing power, constantly increasing list prices, and mix shift, selling more of the most expensive products like the upcoming F80 hypercar and the Icona series. The cars are just getting much, much richer.
But the risks are massive. There are 2 primary paths to impairment. The first is internal, brand dilution.
Succumbing to greed is the greatest internal threat. If management were to increase production to, say, 25,000 units a year, they immediately violate the scarcity principle. The moment a Ferrari is seen as readily available, the premium, and thus the 50x valuation, just vanishes.
But the second risk is the existential technical one, the loss of soul in the EV transition. This is the one the market seems to be ignoring.
This is the elephant in Maranello. This is the biggest threat that justifies the bear case. If an electric Ferrari, which has to be powerful and fast, feels weirdly like a well-engineered EV competitor like a Tesla Plaid, the entire brand premium just evaporates. The customer is paying a multi-million euro premium for a specific mechanical, auditory, and emotional drama.
And the sound, that high-revving V12, that isn't a feature. It is the core product attribute. It's the physical connection to racing history.
Absolutely. The engine noise, the specific vibration through the chassis, that is integral to the ownership experience. Replicating that dramatic connection without the internal combustion engine is an existential engineering and branding challenge. It's not enough to make a fast EV. They must make a visceral, distinctive, proprietary EV.
And this is harder for Ferrari than for, say, a sedan maker. A BMW switching to EV is selling utility and efficiency. Ferrari is selling noise and drama.
Exactly. When regulations force the full shift, Ferrari loses its primary differentiator, the engine drama. It enters a playing field leveled by battery tech and software. And in that arena, companies like Tesla and sophisticated Chinese EV makers have massive advantages that Ferrari, despite its heritage, doesn't have yet.
Let's use that Kodak moment in Maranello analogy.
The analogy is stark. Ferrari is currently over-earning spectacularly on a legacy technology, the internal combustion engine, that is legally mandated to disappear. The soul of a Ferrari is linked to that engine. Kodak made massive profits on chemical film right before digital wiped that out. Ferrari has to perform this painful internal transition while maintaining perfection, or they risk the same thing.
So what are the catalysts that might de-risk this monumental transition?
The first, and most critical, is the launch of their first all-electric Ferrari in 2025. That's the moment of truth. If that vehicle is launched successfully, and if it proves they can engineer an emotional, distinctive EV experience that commands the premium, if it doesn't feel like a silent appliance, it would significantly de-risk the company's long-term value and could trigger a massive stock re-rating.
And you also have the continuous halo effect of the supercar cycle, which keeps the cash register ringing.
Right. The launch of the new F80 hypercar acts as a huge halo effect and a direct profit injection. These cycles prove the Veblen dynamic is still very much alive.
Okay, let's engage in some second-level thinking. We know the market consensus.
The consensus is simple, maybe lazy. Ferrari is an asset. It's a recession-proof luxury stock. Buy it and hold it.
But the critical contrarian view focuses solely on that engine. You said the transition is technically harder for Ferrari. Let's really hammer that home.
The difficulty is emotional engineering. An electric motor delivers torque instantly, silently, linearly. A V12 delivers drama. Mechanical complexity, high-frequency sound, a torque curve that builds to a screaming climax. That climax is what the client pays for. If they lose that, if they're just selling linear speed, they enter a level playing field with cheaper rivals. The market is betting on engineering genius, but ignoring the high probability that emotion is impossible to digitally synthesize.
That brings us to Pillar 5, Final Investment Memo Synthesis. Let's bring the bull and bear arguments into sharp contrast.
Starting with the investment thesis, the bull case is powerful and historically proven. It's one of the easiest buy theses to articulate.
Unrivaled moat. Strongest brand in the auto world, unmatched pricing power, impervious to inflation.
Financial physics. The margin's 38% EBITDA, ROIC over 20%. These belong to a software company, not a manufacturer. You can't ignore the high quality of earnings.
And resilience. That 2-year sold-out order book provides revenue visibility and cash flow protection that competitors would kill for. It is the ultimate insurance policy.
Now, let's put on the red team challenge hat. The bear case. Where does this perfect thesis break?
First, the valuation ceiling. Perfection is priced in at 50x earnings. If they stumble, if the 2025 EV is just good instead of mythical, the stock will be severely punished because there is no statistical margin of safety.
Then the technological risk. The core auditory signature is threatened. If the brand loses its emotional anchor, the dramatic sound, the premium disappears.
Which leads us to the strongest argument against investing, the Kodak moment in Maranello.
This analogy encapsulates the threat. Ferrari profits from a legacy technology, the combustion engine, that is rapidly becoming obsolete by law. The soul of Ferrari is linked to that mechanical complexity. If they can't invent a new emotional language for the EV era, they risk becoming a high-end relic.
And the consequence, if that 2026 EV fails to capture the imagination of the ultra-wealthy, is truly existential.
If that first generation of EVs is perceived as soulless, the brand moves instantly from mythical to merely expensive. The outcome would be a massive, immediate multiple compression from 50x earnings down to maybe 15x. That would lead to catastrophic shareholder value destruction. This is the dichotomy.
Yeah.
Unparalleled security today, but enormous singular technical risk tomorrow.
So what does this all mean? We've analyzed the unparalleled fortress built on scarcity and psychology, the incredible financial resilience, and this singular massive threat posed by the EV transition.
The core insight for you, the listener, is this. Analyzing Ferrari requires you to abandon traditional auto metrics and focus instead on human psychology, the economics of exclusivity, and the engineering required to preserve emotional drama in an electric age. It's a study in intangible assets with a massive technological time bomb ticking under the hood.
And that leads us to our final provocative thought. The market, by assigning that 50x luxury multiple, is essentially making a massive bet. It believes Ferrari will successfully overcome the emotional and technical sound barrier of electrification.
So the question for you to mull over is this. When the €2 million F80 hypercar is eventually replaced by a silent electric counterpart, a masterpiece that only vibrates but doesn't roar, will the wealthiest collectors still be willing to pay that €2 million premium for the privilege? Or will they turn to a cheaper, equally fast rival? That is the value proposition Ferrari must solve to maintain its flight path.